Hey everyone, welcome back to the channel. Today, I would want to talk about an interesting stock which is starting to gain market traction, Root. If you own a car or is planning to buy a car in the future, you are already a key target segment for Root. The reality is that insurance market is dominated by legacy carrier which underwrite policies the old way. Root's core idea is basically a big screw you to that whole system. They are promising to price your car insurance based almost entirely on how you actually drive, using AI and data. The question for us as investors is simple. Is this a brilliant disruption, or is it just a massive money pit? So, what exactly is Root and the core problem they are trying to solve? Root is an Insurtech company. They sell auto insurance, but they are not using agents or paper forms. Their business hinges on telematics. When you sign up, you download the app and take a test drive for a few weeks. That app is quietly tracking your real driving habits, how hard you brake, how sharp you turn, and your overall safety score. That's the data they use for pricing. This is the entire argument for the company. Traditional insurers use broad data that puts all 30 years old in a certain zip code into the same risk pool. Roots argue that their data let them cherry-pick the safest driver, leaving the legacy carrier with the higher risk pool, and they have collected billions of miles of driving data as of mid-2025. If they are right, this gives them a massive long-term advantage in the most important insurance metrics, combined ratio. For those that are new to this term, we will come to that in a bit. But for now, remember that combined ratio under 100% means they are profitable on underwriting. Their goal is to drive that ratio down far below industry standards. Now, before we talk about how they plan to grow, we have to appreciate what they are fighting for. We are talking about $300 billion US auto insurance market. That is an enormous price, currently dominated by household names like Geico and Progressive. Here's a strategic point that gives Root a fighting chance. Unlike life insurance, which locks you in for decades, auto insurance policy have a short life cycle, usually 6 months or 1 year. This short term means two things. Number one, high churn. The customer has a built-in frequent excuse to shop around every time the policy renews. About 20% of auto insurance customers switch carriers annually. Number two, low switching costs. It's relatively easy to switch. You don't have medical exams or complex underwriting. You just compare quotes and cancel the old policy. This high churn, short-term cycle means the whole industry is ripe for disruption. If Root can prove they have a superior, more accurate price, which they claim their AI delivers, this positions them to steal customers from the competition. So, to truly understand Root, we need to understand the rules of the game. When analyzing an insurance company, I believe these metrics are vital. Let's start with the non-negotiable metrics, the combined ratio. This is hands down the most important number in the entire industry. It tells you if an insurer is making money on its actual business of writing policies. It's calculated by taking the cost of paying claims or losses, plus the cost of running the business or expenses, dividing it by the premiums collected. The simple rule is the ratio must be below 100% for the company to be profitable on underwriting alone. Growth in a company without a path to hitting this number is frankly pointless. Now, once you establish profitability, you look for scale. That's where growth in premium comes in. We have talked about the enormous $300 billion auto insurance opportunity, but it's just potential until a company can actually capture market share. This metric gives investors an indication of the company's ability to execute its strategy and take business from established giants. As a new and fresh player, we need to see Root's top line growing aggressively. Now that we understand the rules of the game and the massive opportunity, let's look at their growth strategy. At the start, Root followed a typical Insurtech playbook. They spend heavily on performance marketing, Facebook, Google, TV, to drive customers to download the app directly. This is their direct channel, and while it created growth, it was expensive and burned a lot of cash. The entire investment thesis hinges on a strategic pivot away from the expensive model towards efficiency. Root has now strategically organized its distribution into two parts, the direct channel and the partnership channel. The real game changer is the partnership channel, which acts as a strong engine, diversifying their distribution. The most exciting part, in my opinion, of this partnership model is the embedded insurance. So what it is? Instead of spending a fortune to attract a customer to them, they're getting to the customer when they are already performing a high intent action, like buying a car. The core example is the exclusive partnership with Carvana. You buy the car, and Root is right there, fully integrated via API, offering you a quick, seamless quote and binding experience. This embedded model is now expanding to new partnerships like Hyundai Capital America and Experian, delivering a key strategic advantages. However, it's vital to also note that this partnership does come with a cost. The Carvana warrant structure, for instance, Root incurs non-cash expenses tied to policy origination milestone, which can periodically impact the GAAP net income. While this can pressure GAAP net income, management views this as a high-quality expense because it is directly linked to successfully acquiring high-value policies, and it does not affect adjusted EBITDA. If Root can successfully replicate this embedded model and continue to expand its geographic footprint, which they are doing in new states like Michigan and Washington, their growth can become much more capital efficient and less reliant on unpredictable ad spend, which is a major signal for investors. But let's not sugarcoat this. Root has lost a lot of money. It's the nature of a tech company trying to scale in a legacy industry. You have to spend to build the product and to acquire the initial customers. But as investors, we are looking for signs of inflection point, and we are starting to see those signs. We talk about combined ratio, but let's look one level up at loss ratio, which only accounts for claims costs. Historically, Root's loss ratio has been above the 100% range, but has gradually stabilized and went below 100. This is a strong validation that their AI is working. Root's investment thesis rests entirely on their ability to get this number well below the industry average, because their tech is supposed to be that much better at avoiding bad risk. The growth in those new partnership channels should also mean that their overall operating expense are shrinking relative to the amount of premium they collect. If you look at the marketing expense as a percentage of premium, this has been on a decline. Both these drivers are frankly the key profitability levers for Root. So, let's sum it up. Root's goal is to disrupt the auto insurance market, and the opportunity is massive if they do it right. They have tested with what works and what doesn't work, which has supported the strong turnaround story. While it's all rosy, there are risks for sure. Over-reliance on partnership has a strong negative impact if they lose key partners. Likewise, its performance hinges on its telematics and data in driving down overall combined ratio, which may turn sideways. So, what are your thoughts on Root? Share with us down in the comment below. And that's all for today. And as usual, do give us a like if you enjoyed this and subscribe to our channel for more insightful analysis. Thank you.